Hello and welcome to Inderes TV. Today I'm in the studio with Analyst Rauli Juva to discuss Harvia. Hi Rauli.
Hi Pia.
So, since the Q2 report, all we are hearing is the disappointment in North America. What is the disappointment about and what's the problem there?
Yeah, well, the disappointment was clearly the organic growth. So Harvia has been growing very strongly for many years already, and now in Q2 the organic growth was actually around zero. So all the growth in the North America region, meaning mainly the US, was coming from the acquisition made last summer. So that was clearly the disappointment. If it's a problem or not is maybe up to a debate. So there was some impacts of the comparison numbers and how the deliveries fell between Q1 and Q2 compared to last year. But of course there was also the weaker consumer demand and consumer sentiment following the tariff announcements in the beginning of April. So clearly that has had an impact, and this is basically the first time in years that we saw that Harvia is negatively impacted by anything in the US. So that was definitely a disappointment. But I don't see a big problem. But of course, compared to the expectations, that was clearly weaker than expected.
All right. So as you mentioned, we now have the trade deal between the EU and US and the 15% tariff on exports from the EU to the US. How will this affect Harvia in the future?
Yeah, there will be, well, first of all, they are producing most of the products they are selling in the US in US. So the full sauna cabins and sourcing the wood, of course, they're from US or Canada mainly. So the impact is mainly related to the heater production, which is main in Finland or China, and now of course China having even higher tariffs. It's mostly from Finland to US, and those tariffs will now go from 4% to 15%. So it's not a huge thing. I think they should be able to compensate it by pricing and some of their own efficiency measures. So the direct impact is not or shouldn't be meaningful to their earnings development. It's rather the kind of what this whole tariff involvement impacts the overall consumer demand.
Yeah, so it's a small part of imports from the EU. What about Canada? And I'm not up to date on that tariff agreement, but with the wood procurement, is there a risk that, or can they move all the procurement to the US if something happens on that front?
Probably not all. Yeah, there was this tariffs. I think they are in place, and the wood cost reacted at least going up already ahead of those. So yeah, there is some elevated cost also regarding the raw material in that side. But also regarding that, I think of course that's a problem for the whole industry then, and,
Right.
and it should be mainly passed on to the prices. So I wouldn't expect any major problems from that either, because the pricing power for Harvia and for the industry is generally quite good. So there shouldn't be a problem. But obviously, if the growth in the industry weakens like we saw in Q2, and you have simultaneously cost pressure, that might lead to some margin pressures. But we're not expecting any major impact from that.
Okay. So what about other geographical areas? What was the growth rate outside the US and
Yeah, well, in Europe it's easy. It was zero. It's very flat, but in both Northern and Central Europe. So the markets are still quite weak. They haven't really gone up from the downturn we saw following the big boom during COVID times. So nothing much happening there. Hopefully they are rather starting to recover at some point than going downwards. But no developments yet. And then in the APAC and Middle East region, which is the other segment they are reporting outside Europe, besides North America, the growth was really strong. It was over 50% this quarter, even if in the comparison period they also grew like something like 80% or something crazy. So they are really going strong there, and that is turning into a meaningful growth driver also for the whole group. So that's a positive development. So overall, the picture is very much the same we have seen for a few years now already, that Europe is going down or flat at best, and the other regions are growing.
Right. So in Q2, the EBIT margin was 17%, which is lower than normal, which has been around 20.
Yeah.
What's the reason behind this, and should we be worried about it?
Yeah, the simple reason is that the sales development wasn't as high as the company expected or hoped, and they are putting quite a lot of resources in kind of driving and securing also the future growth and building the organization for that. We have seen that now already for I think 2 years, 1.5 years at least, and that will continue in the coming years. So the fixed costs are going up, and then when you have a quarter that the sales development is a bit weaker, then the margin obviously goes down. Whether we should be worried depends again a bit on the expectations. So obviously 17% is still a quite good level. Their target is to be about 20, and they definitely can achieve that in even for the full year this year and going forward as well. So in that respect, it's not a problem. But then if we look at the expectations, which are kind of assuming that we will see some operative leverage and the margin would actually go up some percentage points kind of towards the 25% level in a few years. Compared to that, you might say that maybe those forecasts might turn out to be too optimistic if they continue to increase the cost like this, and then the top line doesn't grow maybe as strong as it has, for example, last year. So yeah, there might be a bit of a risk compared to expectations, but overall compared to the company's targets, I think they are doing fine, and it's definitely the right strategy in my view also to focus on kind of taking the market positions and driving the sales growth also for the longer term rather than trying to maximize the margins now in the short term.
Yeah. And in the latest report you wrote, valuation is quite high. Could you elaborate on that?
Yeah. Well, as we can see here, it's a P. It was above 30 for quite a while before the earnings, and obviously the stock took quite a big hit. Their estimates came down as well, but not as much. So now the P seems to be around 27 for this year. EBIT is around 20. So those are, I think, for most those sound high in comparison to the some general market or consumer sector, but then definitely Harvia is a quality company with strong cash flow, strong growth prospects, still with the high margin and return on capital. So also relatively high multiples are warranted in that respect. But yeah, we still think that they are perhaps a bit too high compared to the earnings growth expectations they can, or the growth they can deliver in the longer term.
And the recommendation now is?
It's reduced.
Okay. Thank you, Rauli.
Thank you.
So a slower quarter, but nothing really to worry about. You can read more at Inderes.se.